Hey everybody, I hope everyone is doing well and had a good day. Thank you for joining me for today's end of day review, and in this video we will go through the Emini 5-minute chart for Monday, November 17th, 2025. Gap down going into the day, so let's just briefly check out the Globex chart, see what the market was doing going into the day. So we know there's a gap down. And the question is it a bear trend or is it a wide trading range going into the day? And here's the information that we have. This is the 15-minute chart. You can see it's a tight bear channel. And here, it's a micro channel all the way down to the opening bar. So if we look at the structure, it's 2 legs down, 1, pullback, 2. But the problem for the bulls is that this is too tight. On a higher time frame, you would not see this pullback. You wouldn't see any of these bull bars. This would simply be a bear breakout. Breakouts get second legs most of the time. So the expectation after these 2 legs down, tight bear channel, probably get a minor reversal and then another leg down. Until the bulls break a significant trend line and then get a retest of the lows, they shouldn't expect very much. So the expectation, the best case scenario for the bulls here, probably a trading range. So with that said, with that in mind going into the day, strong rally bars 1 and 2, consecutive bull bars closing on their highs. Good for the bulls, second leg up, likely. But remember the context going into the day. It's against a really strong, tight bear channel, a micro channel. So is this the start of a bull trend, or is it just breaking that trend line? And if we imagine the open of the day or the low of bar 1 is the bottom of that bear trend, and the odds are we're going to retest the bottom of that bear trend. And then you know the stat, only about 20% of days have bar 1 remain the high or the low of the day. So any given day, it's not very likely that bar 1 will remain the high or the low of the day. At this point of the day, maybe instead of 20%, it's 30 or 40% with consecutive strong bull bars. We get a pause, second leg up, but testing resistance, breakout point up here. Maybe these bull bars where the bear breakout began up here, we're approaching resistance. And then strong reversal down, bar 6 outside down, and then expansion, bigger bar 7, second leg down, likely after 6 and 7. So yes, a second leg up is likely for the bulls, but the problem is what I mentioned on the Globex chart and the higher time frames. This might just be a trendline break before we test the trend's extreme, the lows, which is the open of the day and the low of bar 1. So 3-bar micro channel, 6, 7, 8, second leg down, likely, probably, sells above bar 8, bad stop order buy. Inside bar 9, trading range bar, sellers above, second leg down, likely, low 1 short, but sell the close, bears on 8, disappointed, bar 9, they may buy back shorts on bar 10. And it looks like that's what happened on 11. What about 12? Double bottom, high 2, bull flag, bull breakout, pull back, high 1, pull back, high 2. One of the problems for the bulls is what I mentioned, the higher time frame context, but also here, 6, 7, 8, is that what you want to see for a pullback if you're a bull? Fell below the 50% pullback level, and it's stronger than you want to see, stronger selling than you want to see in a pullback. The question is this a pullback before a second leg up, or is this a reversal down, and then this is a pullback for this breakout? Bear breakout, low 1, low 2, second leg down. Some buying pressure through here, but tight trading range. All the bars basically completely below the moving average. So the bulls probably need one more bar here. And even if they get it, probably resistance up here. There are layers of resistance. You've got the low of bar 5. Traders buy the low of 5. It's a strong bull bar in a micro channel. They get trapped on the breakout. Also buy the closed bulls on 5. Trapped on the bear breakout. This area is expected to be resistance. So the upside here probably limited. Bear breakout still needs a second leg down. It's possible bar 10 is the second leg that the bears get. But to me, it doesn't look like it's enough. It looks like we need a more symmetrical second leg with maybe 3 to 5 bars similar in size to 6 through 8. Outside down, 13. Bulls hoping it's a high 3, high 1, high 2. 13 setting up a high 3. Bears hoping it's trend resumption down. What's the problem with the bear case? The bears second leg down likely, yes. But even if we get below bar 1, the downside is probably limited. You think about the buying from bar 1 to bar 5. It's a lot of buying. It's a 5-bar micro channel covering a lot of distance with very little selling pressure. So the reality is that even if we get below bar 1, and again, we probably will, it doesn't look like this is a trend from the open bull trend day. There's about an 80% chance we get below bar 1. But even if we do, is the expectation that sellers will become aggressive below bar 1, or will they look to take profits? You always have to think about trapped traders and breakouts. And on the open, we have the gap down. You can imagine the gap down is simply a bear breakout, or you can imagine the Globex chart, tight bear channel, bears selling for any reason. They get trapped on the reversal up and they're disappointed. And that creates support back at the open of the day and at the low of bar 1. $15 again, bulls hoping it's a high 3, bull flag, but the pullback is becoming deep for this bull breakout. It's pulled back, it looks like about 75%. When that's the case, it's less likely a bull flag, more likely a trading range or an opposite trend. So 15, it's a good looking bar for the bulls, but it's kind of similar to bar 12 with the overlap right at the moving average. Bulls probably need one more bar. The bears look at that and see great value for selling. It's a bear breakout, tight trading range. Bears see a bear flag, so volatility expansion, volatility contraction through here. So basically breakout, pullback, and then they're looking for a second leg down. So bears will sell the close of 15, betting that the bulls don't get one more bar. And even if they do, there's layers of resistance up here. And then we start getting bear bars, bad stop order buy, 17, sellers above, and then 19, a bad stop order buy, probably sell the market, sell above, give a bar, vacuuming down to the low of bar 1. But again, probably support in this area. So the downside here might be limited. Lots of trading range price action on the open today. Is today a bear trend day? Probably not based on the open. If you go back and do a day type or day structure study, you won't find many bear trend days that begin with strong consecutive bull bars like we had today. So this will decrease the probability that today is a bear trend day, increase the probability of some kind of a trading range day. It's basically big up, big down. Now we have 2 legs down to support. So bears may look to start to take profits here, and bulls may look to buy, but not much for the bulls to buy here. Although, bigger picture, maybe it's a broad bear channel, maybe something like this. You can always mess around with trend lines and trend channel lines. Looks like there's support here. Market rallied here, touched this line again, rallied, touched it here, rallied. So we might find support on this channel line. So testing it, bar 21, 22. The only way you can justify selling this far below the EMA is if you're selling momentum. The bears are not selling value down here. You're selling far below the average price. And the only way you can justify doing that is if there's sustained momentum. You have to be careful when you're selling a possible late leg, maybe 1, 2, 3 big legs down, far below the EMA on support. So if you're not getting immediate follow through, or you get a bull bar closing above its midpoint, it might be safe to have a default exit and just look to get out and sell below a bear bar. So bar 23 is what I'm talking about, a bar like that. In this context, 3 big legs down, far below the EMA, pretty decent bull reversal bar. Maybe just exit shorts. Always in bears probably exit above 23 and look to sell higher. It's an aggressive buy, but it's a value buy for the bulls. They may buy and scale in lower, betting that today is not a bear trend day, and if this isn't the low, that maybe we'll get a low soon, and we'll probably test these highs. This rally was strong enough to trap traders, and that should cause a reaction or a response. Meaning when we test support, you find buyers, and then the market has to rally again to find more sellers. So a vacuum up on bar 24, again possibly 3 legs down, maybe a leg 1 breakout for the bulls, but a huge bar, big risk, forcing you to buy right at resistance, the moving average, breakout point over here. So not ideal for buying, but it is likely that the bulls will get a second leg up after this reversal and follow through. More follow through buying, nothing for the bears to sell. But as we approach resistance, like the low of 5, maybe the top of this tight trading range right in this area, you can start to expect some profit taking from the bulls, betting it's a trading range or a broad channel. You trade them the same way, buy low, sell high. So this is high near the trend line. This is a profit taking area for the bulls and an area where the bears would look to start to sell. But if you're a breakout trader, if you're trading breakouts and second legs, there's really nothing to sell here. Finally starting to go sideways at resistance. Bears again hoping it's a broad channel. Market turns down at resistance, the trend line. We fell from this line here, rallied back to it, found resistance, rallied to it again, found resistance, rallied to it again. Markets have inertia, and they tend to keep doing what they've been doing. So it's logical to think this trend line will act as resistance here, and it's logical to look to go short. But after this rally, it's aggressive. You might want to wait for a bear breakout signal. And this is pretty weak from the bears here. Small bar, bars, doji bar, big tails below bars. Tight trading range for the past 5 or 7 bars. It's becoming breakout mode, tight trading range at an area of resistance. Is the market going to break out above this resistance into a strong bull trend? Probably not. If I had to predict what's going to happen, I would think it's probably a trading range day. I remember thinking back somewhere around this time, maybe here, somewhere in here, that it might be an expanding triangle day. So here's the low, rally to a new high, sell off to a new low. I thought we might rally to a new high of the day up here, and then turn down, find seller up here, and then turn back down to a new low. But in this case, we didn't quite get there. And then here's a breakout, bar 38. On a smaller time frame, this is a spike in tight channel, bull trend. followed by a trend line break, and then a weak retest of the highs. And then this is a lower high major trend reversal. So if we look at, let's see, 1240 on the 1 minute chart. This is basically it, spike and channel. There's a bull trend line, sideways trend line break, weak three-legged retest of the highs. It's a lower high, and the bear's hoping this is a lower high major trend reversal. Probably a signal similar to 23, where if you're long for any reason, it's safe to get out below 38, just look to buy lower, because the risk is if you're buying here or if you're staying long, there's no difference between buying below 38 and holding on to a long position that you bought above 23. It's the same position. You have to have that always in mindset that if you buy the market, even if you bought down here, you have to think the entire time, at every instant, that you're buying. And then you have to be able to justify staying long here below 38. And if you cannot justify buying below 38, then you have to exit longs below 38. So on the minor scale, bull trend, trend line break, retest, lower high major trend reversal. And again, the risk with staying long here is that this is a wide trading range or broad bear channel. If that's the case, the bottom of the range could be all the way down here. So do you really want to stay long or buy here with a stop somewhere? I mean, the stop location below 23, 22 is incorrect because that is expected to be an area of support. You don't want to put your stop at support. So you'd have to really put your stop very far below this structure. The problem with buying here, staying long, is that it might be a wide range and it's better to buy low and sell high. Strong follow through 39, probably sell the close 39, sell the close 40. Bad stop order buy. It's a reversal bar, but context is good for the bears structurally. Might be a reset for the leg count, even if you call it leg 2 here, 1, pullback 2. It's still fairly high in this range. And if it's a trading range day, which it probably is, gaps tend to close. We have an open gap down here, so this is a test magnet. So I'm expecting another leg down after this bear breakout, at least to this gap, probably to a new low. And then at that point, expecting support. So sell the close 40, bears getting follow through. Now at this point, I'm expecting support because look to the left. Last time the market was here, we rallied for a lot of bars and a lot of points. But it's kind of similar to back here, where maybe just have a default exit, just get out above a bull bar, closing above its midpoint. But for this, on the way down, really nothing to buy here, especially for a trader trading breakouts in second legs. Where is the signal to go long? It really doesn't exist here. 45 a weak bar, doji 44, tail above 45, inside bar 46, nothing to buy here. This sell-off will probably get a small second leg down. And on a smaller time frame, this is 3 attempts to reverse this really tight channel. It's a breakout. So lower price is likely. Tight trading range near support. We may start to find buyers in this area. But until there's a signal to buy, better to stay always in short. What about 51? Is that an always in flipping bar? Some bears might exit above 51, but there's a lot of overlap with the prior bars. It's a tight trading range. It is near support, maybe this channel line, maybe this gap that closed. and you can exit above 51, but if there's a weak follow-through bar, then bears will sell again. So bears might sell that. It's a reversal bar, closing below its midpoint and finding resistance at the EMA, or they'll wait for a bear bar closing on its low, sell below 53. Breaking below the channel line, so we're entering low probability territory. Bear channel, breaking below a bear channel line. Usually, bear channels break to the upside. You can think of a bear channel as a bull flag. There's no difference. On a higher time frame, this could simply be a big bull breakout, and then this wide, broad bear channel before another big bull breakout up. The problem, though, is you have to measure the buying pressure through here. In this last leg down, open gaps on the way down here, more open gaps on this breakout. So yes, it might be a late leg at support, but until there's evidence of buying, it's really hard to justify buying. It's really aggressive to buy. So I think it's reasonable to look to take profits here, but as far as buying, I would not. So take profits on shorts is fine, but to buy, again, just wait for a breakout. Look to capture its second leg. 55, a weak stop order buy, probably sellers above. Bad stop order buy, 60, sellers above. Now we have 3 legs down here. 1, pullback, 2, pullback, 3. Approaching yesterday's low, that's what the blue line is. You can expect support at yesterday's low. If you look at the daily chart here on the left, bull trend bar closing above its midpoint. It's a bad stop order sell below the bar. It's also near support. It's a trading range. Big up, big down, big up, big down. Probably support down here in the lower third of the range. So as far as yesterday's low, probably a support area. Better for bears to take profits there, and bulls may start to look to buy. So not great for selling in this area. It's also a late leg far below the EMA. But again, from the price action breakouts perspective, trading breakouts and second legs, where is the bull breakout to buy? There really isn't one. Really, the bull's getting consecutive bull bars, but still fairly weak. Yes, there's several legs down, so we'll probably correct for maybe 10 bars, 2 legs. This might be 5 or 6 bars sideways to up. Maybe we trigger the low one, get a second leg up, but this is still a minor reversal. Still always in short. Low one, but bad follow through after 73. Inside bar, trading range bar. Finding some support at yesterday's low. So again, the blue line is yesterday's low, broke below, bad follow through. Now the market's hovering around this price. And then there's the second leg up. So leg one, pull back, second leg up, but testing getting close to resistance. Breakout point here, breakout point here, area of resistance. And you can see a reaction on 77, profit taking, but consecutive strong bull bars crossing the EMA, second leg up likely. So first reversal down, probably minor, and that's what bar 77 was. 78, testing the channel line, which became resistance. It was support back here. Every time the market touched this line, it rallied, touched it again, rallied, touched it again. You expect a rally, but instead we fall below it, and that traps traders. So when we test it again, you can expect it to act as resistance, but out of time for this day. Alright, that's going to be it for today's end of day review. Thanks everybody for joining me, and I hope everyone has a good night.